device at bnn.ca.
Bruce is in Airdrie, Alberta. Hi there, Bruce.
Oh, hi, Mark. Hi, David. My question, you talked earlier about some of the drug companies. My question was concerning Eli Lilly. I've owned this in the past, made some money on it, sold it, and I'm just wondering whether, with the dividend yield that it's at now, whether this would be a good time to get in. Do they have anything in the pipeline that's coming up that would positively affect it? And do they have anything on the negative side in terms of patents that are expiring that might cause it to go the other way?
Okay. So clearly, all of these companies are facing what they call the patent cliff, right? There are a lot of these big drugs that they all have, that are coming off patent, which pose risk to revenue. The point we would make is at this point, all of those things are pretty well known, and the stocks are cheap. Lilly's trading at 11 or 12 times earnings. You know, you got a 5% dividend yield that is very well covered. So I think that the dividend is safe. I think that you have very good visibility into the cash flows. And I think that if you were to look at this group as one to say, what happens if the economy winds up being a little weaker than we think, this is a group I think that's pretty well defendable. So, you know, we like Abbott, we like Merck, we own some Bristol Myers. I don't own any Lilly, but really this group is one that is universally hated and is underowned, but where there is a catalyst, and the catalyst is that the business models seem to be changing, where they're looking at pushing additional drugs through the same pipe, and they've become very cost conscious, and they're really distribution companies today as opposed to development companies.
Right. Here's Rob. He is in Ottawa with a question for you. Go ahead, Rob.
Hi, Mark. One of the things that's been keeping me up at night over the last year or so has been the volatility in the common share world. And Dave, I'm sure it's been keeping you up as well, including common shares that are paying dividends. As well, you probably agree the bond market is somewhat overbought and perhaps subject to a correction. So I was wondering if you can comment perhaps on whether you or not you think preferred shares may be the happy medium between the two.
Mm-hmm. So, Rob, it's interesting. When you look at studies that have been done on what drives return, especially in yield-driven securities, what they found is if you went back over 20 or 30 years, the very best performing part of the equity market hasn't been the highest dividend payers. It's been ones with a good dividend, but one that has grown substantially over time. So if you can get a yield plus growth in the yield, you can get a total return somewhere in excess of what that dividend yield is. Now, preferred shares, for the most part, offer a fixed rate of return. So it's like buying fixed income. And so I would argue that if you don't like fixed income, pure fixed income, especially investment grade or better, then probably preferreds are not the place to go. We prefer to find common shares that have a growing dividend yield. So, you know, we have a very large exposure to real estate investment trusts. We think that group continues to be revalued, very high occupancy levels, low cost of capital, but you get growth in the distributions. The energy infrastructure space, which we'll talk a little bit about tonight, good solid growth in the dividends, 5, 6, 7% growth in the dividends. If you look at the way those companies have behaved over the last year, despite the volatility in the market, they certainly sold off a little on the weekdays, but in a matter of days, they came back to the highs. And we think that the appetite clearly in the market is for yield, and that's not just private investors, but institutions. And we think that on any sell-off, you see buyers come into the space. So I would prefer to buy common shares with a growing dividend than a preferred share with a fixed dividend at this point.
Just need a name, David, because we have to move along, but which is your favorite REIT?
Favorite REIT? Well, I suppose you'd buy a Callaway if you had to pick one.
Right, okay.
Callaway or H&R.
All right, fair enough. Let's talk to Jose, who's in Toronto. Good evening.
Good evening. Thank you for taking my call.
Sure.
I just wanted to know the guest's opinion on General Electric for the long term. Thank you very much.
Sure. So in general, we're cautious about industrials. Having said that, I think that GE is a really interesting company because a big part of their business is gas turbine engines. And so whether it's for gas turbine engines for a power plant, or for industrial uses, we think there could be a lot of growth in this space. Their financial services business, I think, is in pretty good shape. So this is a company, I think, you pick up just about a 4% dividend. You're going to see a dividend that grows over time. Dividend 68 cents. They earned $1.54 last year. They earned about $1.80 next year. Very well covered. You could see a rising dividend payout. I think that this is a good balance between owning an industrial and owning a company with a long-term secular growth trend.
Do you hold GE?
We do have a small amount of GE currently in the portfolio.
All right, then. Now, David, it is time for the Market Call Minute. Pierre, via Twitter, would like to know about Apple. You can go a little bit longer because it is a fascinating company right now. And you hold it too.
Listen, I think if you're going to own a stock, even though it is not a cheap stock or sort of from a price perspective, this is one I think you have to own. If you believe the market can work its way higher, Apple is going to participate in it. Lots of cash, great growth rate, and they got lots of scope to continue to grow the company.
And buy it here at 530?
I'd continue to buy the stock. Look, you got to have a stop loss on everything. But if the market's going to hold in or rally, Apple certainly is going to participate in that, probably to a greater degree.
And you've got an Apple product right in front of you, the iPad. Here's Harry in Toronto. He wants to know about Pembina Pipeline.
Pembina Pipeline is one of our very largest positions. We really like the energy infrastructure space. We would rather own energy infrastructure than oil stocks themselves, because when you look at the volumes of production over the next 5 years, we're going to get a sharply increased production, and Pembina will participate in the traffic that passes through their infrastructure.
And you like the Provident deal?
We like the Provident deal. We own both Provident and Pembina.
Here's an email or a call actually, from Peter in Richmond Hill, Ontario. He'd like your opinion on Continental Resources.
Okay, so I talked earlier about some of the growthier oil companies. This is one we own the stock.
Hal in Vancouver on TD Bank beat earnings estimates this week and raised its dividend.
Okay, so we don't have a lot of bank exposure, but TD Bank is one that we own. They're doing a great job with their retail bank in the U.S. And of course, while we think banks are challenged from a valuation standpoint, the Canadian banks are much better than the rest of the world.
Speaking of challenged, Loblaws, Linda in Lethbridge wants to know your opinion.
This continues to be a very difficult story. Loblaws continues to run into difficulties in execution. It's a stock that I'd avoid. Kevin in Montreal on Sherritt. Again, basic materials, I think you could avoid the stock currently. Lawrence in Winnipeg on Peyto, a natural gas play. Yeah, again, you've got to be very careful with natural gas itself. Prices can continue to go lower. There's a lot that's coming out of the ground. And Larry in Campbell River, BC, SNC Lavalin having trouble of its own lately. Yeah, growing backlog, but when you've got the risk of corruption and allegations, it's going to put a lid on the stock until that gets passed. I think you will want to avoid the stock, and in disclosure, we're short the stock. Well done for the market call, 2 minute or so, I guess that was, but we got lots of stocks in there. I'm sure you're glad to hear David's opinion. We'll come right back. We'll get more insight from David with his top picks.